Good morning. Thank you for joining us for today's webinar, PPP Forgiveness Guidance and CARES Act Impact on Financial Planning and Retirement Plans, presented by Investment Partners and Reyes and Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation for the Licking County Chamber of Commerce. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. When you receive this email, you will also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenters. Your feedback is important to us as we determine future webinar topics. Also, if you'd like a copy of today's slides, you will find that they're available in the handout section of the webinar dashboard on your computer screen. Securities and advisory services offered through Commonwealth Financial Work, member FINRA, SIPC, a registered investment advisor. Investment Partners Ltd. is a registered investment advisor. Additional advisory services offered by Investment Partners Ltd. are separate and unrelated to Commonwealth. Fixed insurance products and services offered through Investment Partners Ltd. or CES Insurance Agency. Today's webinar will be given by Doug Feller, Brigette Lafferty, and Doug Houser. A principal and financial advisor at Investment Partners, Doug Feller has more than 15 years of experience helping clients develop, implement, and monitor financial plans and investment strategies. Doug's primary industry background in the areas of personal financial planning, portfolio development, investment research, company-sponsored retirement plans, 401ks, simple IRAs, cash balance pensions. Brigette Lafferty is a senior plan consultant with more than 10 years of experience in the accounting industry. Brigitte's main responsibilities include plan administration, plan design, plan consulting, asset reconciliation, and tax form reporting. Her areas of expertise include creative plan design, client relationships, plan compliance, tax form 5500, and asset reconcile. We're getting tongue-tied this morning, so I'm sorry, guys. Okay. As a principal and director of construction and real estate services at Reyes and Associates, Doug Houser is committed to building out and growing the construction and real estate services segment while continuing to ensure that we are known industry-wide. Doug has more than 25 years in the accounting industry, and his areas of expertise include financing structures, cash flow management, balance sheet management, succession/exit planning, and long-term capital liquidity event guidance. Today, Doug Houser, Brigette, and Reyes and Associates and Doug Feller of Investment Partners will provide attendees with insight into the new updated PPP Forgiveness application, tips on risk mitigation, the CARES Act impact, additional COVID-19 loan relief, and more. And now I am passing it on to Doug Houser.
Wow, thanks, Imani. That is quite a mouthful. I'm surprised you had to get through all of that. I apologize.
I tried to keep it together.
Yeah, I apologize on our behalf. But thanks all for joining us today. We want to, first of all, make this as interactive as possible. So please, I know particularly when it comes to the PPP forgiveness, there is certainly a lot of changes that have taken place, more changes to come, in fact, so which we'll talk about. So please submit any questions that you have, and we'll try to get to those. So with that, we'll get started. So first slide, please. So with regard to the PPP loan forgiveness, as many might know, this legislation was finally passed last Friday to provide some additional flexibility to the PPP program. The covered measurement period can now be 24 weeks versus the original 8-week period. The thing to note here, however, is that the language that we have seen at this point, you can choose either the original 8-week period or the 24-week period. But we don't believe at this point that there will be the ability to choose any period in between that. Now, the other question that brings up is, okay, well, if I chew through all of the PPP loan funds after 8 weeks, but before 24 weeks, can I go ahead and apply for forgiveness at that time? We don't know that yet either. The banks, I've talked to a number of bank execs, in fact, they don't even know that question yet. the answer to that question rather. And in fact, this morning we got word from the SBA that a new, simpler forgiveness application is on the way. So again, keep in mind this all continues to change. But I think that additional flexibility is certainly important for folks, particularly those whose businesses have been more impacted and are just now, maybe in the last few weeks, starting to open up again, particularly obviously retail, restaurants, dental, some things like that. There are a number that are going to try, I know from talking to our client base, that are going to go ahead and use the 8-week period, even if they haven't gotten through the entire PPP loan. And you say, well, gosh, why would they be doing that? But the thing is, if their business really hasn't rebounded, we have some not-for-profits in this boat that they're still unable to hold many of their events, their fundraising events, things like that. So unfortunately, extending the period actually harms them more because they just can't keep the staff employed and paid throughout that period of time. So it's still what I mean to say by all of this is that it still leaves a lot of planning in place. There's a lot of thought that has to go into what works best for your business. So consult with your CPA, consult with your advisor in terms of some planning and thought process to try to do what works best for you and your business. But the flexibility is good, so we're glad to see that. Again, the amount spent to be spent on payroll costs is now dropped from 75% to 60%. So if your business has a little bit more fixed cost involved in it in terms of facility or equipment, things like that, this provides some additional relief there. The safe harbor employee restoration date moves back from June 30th to December 31st. So there's some ability there to think about where your business might be and can you restore those FTEs if you have an FTE issue currently or through your covered measurement period. The repayment period too has been extended out to 5 years. So again, it's not the end of the world if you can't get the entire thing forgiven, because whatever is not forgiven converts to a 5-year term loan at 1%, which is pretty cheap capital overall. So you know, we talked a little bit about the forgiveness application. Again, you can choose the 8-week period that was originally in place. Keep in mind that the extension doesn't change the loan amount or any of the other restrictions. So that's something as you go through your planning process, you want to be sure to make sure you think through all of that. The big outstanding issue is still the tax deductibility. And real briefly, any forgiven loan amount, they wrote into the CARES Act that it is not taxable income. So that was a great thing, and folks were certainly happy to see that, because normally any forgiven loan is taxable income. But they wrote right into the original the act here that the forgiven loan would not be. However, the IRS subsequently ruled that all those related expenses are not deductible, and that caused quite an uproar. And I understand why they did that, because in essence, you'd be double dipping if all of a sudden, you know, that money that you got was not taxable income, and then those expenses could be deducted. In essence, you get a double benefit. I'm not sure what the intent was. There's a lot in Congress, a lot of consternation over this, so we'll see if they change that. But as of now, this is an entirely tax neutral process. So we'll see. Stay tuned for more on that. Next slide, please. So the application itself, and I'm not going to spend a ton of time on this, again, because we just literally got word this morning that the SBA is going to simplify the application for forgiveness. So again, a lot of this may change, but the key points here are make sure you document. We've tried to reiterate that to clients over and over. Treat this like an audit file or a tax file. Prepare and have all those documents available. Work with your CPA, your bank. Make sure you've got all the required documents and that you can get them to them in the right format, and that they're easily discernible from what you've got there. In other words, don't just submit piles of stuff where people would have to, break out the information. Make it as simple, readable, and easily identifiable in terms of tying those numbers to the application as possible. So that'll require some work. You may have to take some of your payroll reports, for example, and break them out, total them, and provide summation that's a little bit different than maybe what's in those payroll reports themselves. I know a lot of the large payroll providers such as ADP, Paychex, and others are able to put together custom reports for their clients. So check with your payroll provider on that. But again, try to make it as simple and easy as possible. So when you're looking at rent, utilities, identify what's there, what's included, what's not. Again, document, and make it simple. Next slide, please. So the lesson here, what we want to go over is, there was a lot of discussion initially when Secretary Mnuchin came out and said, wait a minute, everybody it has to explain that they really needed these funds, and if not, we're going to threaten you with orange jumpsuits and jail and all this type of stuff. And everybody got concerned. We had a lot of questions from clients. Should we just return this money? Our answer was be patient. In the end, that paid off. Now, what that doesn't mean, however, is that you just have a free pass. So even though they did provide an update that said, okay, anything over 2 million will certainly be reviewed, we still have the right to review any PPP loan under 2 million. So what we want to tell clients based on that is be prepared to maintain this living file for 6 years. That's the statute of limitations that they've provided. So make sure that you document everything that you did going into the process. Obviously there was a lot of uncertainty when the COVID restrictions first came out and, the lockdown was put in place. So document lost contracts or contract changes, issues with suppliers, so supply chain impact. Take a look at your monthly financial results going into this. Also, how that changed as you proceeded in the succeeding months. Impact on your cash position, your receivables, if you had customers that you were concerned about, also payables, all those things. Document those things. Emails that you have, correspondence with customers and others in your industry, print those out, sign them, keep them in this file. So it's a living file. Make sure you write down some of your thought process going into it, because that will show that you did this for the right reasons. And we're thinking about the risk to your business, the uncertainty, the risk to your industry, all those things, so that when potentially 5 years later, somebody comes back from the SBA, pulls your file, you don't have to think back, gosh, what was I thinking back then? What exactly, was the impact? I sort of remember. If you all are like me, I need to write that stuff down, because sometimes I have a hard time remembering what I did last week with things. So absolutely try to just document the hell out of it. If I can put it succinctly, that's what we want to do. And again, I don't think anybody has to be overly concerned. Adhere to the spirit of the program, and you'll be fine. That's the overriding message here. So next slide, please. Poll question. We'd like to get some feedback from the audience here. What does everybody think about this forgiveness application and the process? Be curious to see what the response is. We kind of see it all over the map. Some folks, just want to ask us a couple questions and some clarification on a few things. And we get a few responses that say, hey, I don't want to deal with this. You guys handle the whole thing. So curious to see what our audience thinks on this. Imani, do we have any responsiveness thus far?
So right now we are collecting responses. So we'll give you guys a few more seconds and see what we get.
Yeah, I think overall, most folks that we've talked to at this point, and it's fairly well aligns. I'm a little more surprised about, hey, no help at all. Most of the folks we've talked to tend to be in that middle, which is, give me some clarification on a few things, because there are some nuances certainly in the payroll definitions and what periods to include and that type of thing. So that's good to hear that everybody feels a little more comfortable. So, all right, next slide, please. Again, I don't want to get into too many of the details here with the weeds. This is just a summation of what is required according to the application. Now, again, this morning they say, well, we're going to simplify it. I still think a lot of this is going to be required. In other words, you're going to have to list each employee and all their pay rates and the wages that were earned during the measurement period, that the baseline period that existed, as well as the covered measurement period. So we'll see more to come, but hopefully we can take the reports directly from a payroll provider for any that are of substance and put those right into the application. Now, the banks are all going to have these applications online. It's going to be required to be an online submission. So hopefully they make this process very simple and streamlined. So next slide, please. Just briefly here, the big question we get from a lot of folks, we get this a lot, is it cost paid? How does this work? It's sort of a modified accrual basis, I would tell you. So anything that was paid during your covered measurement period, whether you choose 8 weeks or 24 weeks, is able to be included. And those count payroll costs, rent, utilities, and mortgage interest. However, at the end of the period, you may also include those costs that were incurred through the last date of your covered measurement period and paid on the next regular payment date. So there is some nuance there in terms of flexibility and what you can include. So talk to us, talk to your CPA about the finer points of that if you have any questions. But it is essentially a modified accrual basis. Next slide, please. So where to start? Start with the Schedule A worksheet. That's as simple as I can tell you. And the instructions, I think, are fairly straightforward. So start to walk through some of what you'll need there. Get prepared ahead of time. Don't wait until the end of your covered measurement period. Start to think through the reports that you'll need and all the information that will be required in there. There are two separate tables, one for those that are less than 100,000 in annualized pay. And again, the key there is annualized for any pay. So even if somebody made $20,000 a year, but you gave them a $5,000 bonus during one pay, if that caused an annualization that was greater than 100K, then they go in one table, more than 100K in another separate table. So again, a little bit of nuance. You just want to make sure that you follow the instructions to the T, have somebody review it, go through, make sure you understand that. So next slide, please. So this is the lender good faith review. We talked about this. Just again, be prepared. The lender's going to confirm the documents that you submitted and all that stuff. Work with your bank, talk to them about what they want to see. Again, talk to your CPA, make sure you've got everything that's required. They're going to confirm all those calculations. They're not necessarily going to verify anything. So confirmation is a little bit different than verification, but that's it in a nutshell. We want to certainly let Bridget and Doug spend a lot of time on the CARES Act, because that's very important with regard to retirement plans and the impact there. So we'll take a couple of moments here for a few quick questions on the PPP if we have any. If not, we'll certainly gather some of those at the end as well. So do we have a question or two, Imani, that we want to handle now?
Let me double check. We do not have any questions yet, so we are good to go.
Glad everybody understands it. It's clear as mud sometimes to us. We spend a lot of time trying to understand the nuance here. But with that, we'll let Bridget and Doug get started. Bridget, give us some information about what's going on with the CARES Act and the impact on retirement.
All right, thank you, Doug. Amani, next slide, please. Okay, so we're going to look at defined contribution plans first and what the CARES Act has done for these retirement plans. So plans may permit COVID-19 distributions from a participant's vested account balance penalty-free, and they're able to do this through December 31st, 2020. And this is a new type of distribution. It's called a CRD. So if you hear someone talk about taking a CRD, it's actually the COVID-19 CARES Act distribution. Plans may also permit for increase to participant loans. It's going to be loan limits, and it's going to be extended periods. So who are eligible employees for these COVID provisions? So it's a participant who's been diagnosed with COVID-19, your spouse or a dependent has been diagnosed with COVID-19, or the participant has suffered adverse financial consequences due to COVID-19. It can be the result of quarantine, furlough or layoff. You could have a reduction in hours at work. You could have an inability to work due to childcare, since most of the childcare has been shut down. You may not be able to go to work because you don't have a care provider. Maybe your business closed, and there's other factors determined by the IRS that will make you an eligible participant. And the plan administrator, the person that owns the plan, may rely on that participant's certification for eligibility. So if they come to you and say, I have COVID-19, my spouse has had COVID, I'm having issues with this, you can rely on their certification. Next slide, please. So we're going to look at the distributions first, those CRDs. It's limited to $100,000 per tax year, and that's aggregated across all plans of an employer. And basically what that means is if you work for a company, let's say has 2 or 3 retirement plans and you're in 2 of those, you could take $100,000 between the 2 plans. If you work for a typical company with 1 retirement plan, you are able to take $100,000 if you have that in your account balance. These distributions are not subject to the 20% mandatory withholding. And that's because CRDs are not considered an eligible rollover distribution. Typical distributions, if you take them in cash, you have to withhold a 20% mandatory withholding. With the CRDs, since they are not an eligible rollover distribution, you do not have to withhold any taxes from them. They're also exempt from the 10% early withdrawal penalty. Typically, if you take a distribution in cash before you're 59.5 years old, you're penalized 10% on the back end. With the CRD, these are not penalized. So that's one of the beauties of the CRD as opposed to a typical, let's say, a hardship distribution, is you're still, with a hardship, you are taxed at 10% on the back end. With the CRD, they have exempted those from that 10% penalty. Now, if your plan had spousal consent, that still applies, which means if prior to COVID, you had to have your spouse sign off on your distribution, allowing you to take this distribution, that still applies. So if you take a CRD now and your plan requires that, you're still going to have to get your spouse's signature notarized. And then RMDs may also be waived for 2020, and this includes all types of plans, 403B, governmental 457s, IRAs, simple IRAs, and SEPs. And Doug Feller will go more into RMDs on his presentation. Next slide, please. So these CRDs may be indirectly rolled into an IRA or employer plan within 3 years from date of distribution, and they cannot be directly rolled into an IRA or another plan. And what that means is you have to take the CRD in cash, and then you have the ability to roll that money back into your retirement if your plan allows, or an IRA, and you have 3 years. You cannot take a CRD and automatically roll that into something else. It has to be taken in cash, and then you can pay it back. So these amounts that are not directly rolled into an IRA or a plan are included in your gross taxable income, but it's ratably. So it's over 3 years. So you would actually pay tax on 1/3 of the distribution for 3 years, unless you elect to do it in a single year. Now, more guidance is needed, but it is assumed that if you do pay some of this back, that you'll be able to claim a tax credit for those income taxes previously paid. And so if your employee takes a CRD and is later terminated, this termination should not impact their CRD. So, if you were affected, you took a CRD and then you later terminate, let's say you either willingly leave or you are terminated due to, the business, it will not impact that CRD provision. So you will still be able to pay that distribution back. You will be able to do your taxes over 3 years. Next slide, please. Okay, so now we're going to look at the loan relief that has happened in the CARES Act. And there were 2 types of relief provided. And so the first one is if your plan allows loans, the loan limit's been increased to $100,000 or 100% of your vested balance. Now, this only applies to loans that are made on or before September 22nd, 2020, and that's approximately 180 days following the CARES Act amendment. Prior to COVID, loan limits were the lesser of $50,000 or 50% of your vested balance. So they've basically increased the loan limits through September 22nd, they've doubled it. So upon request, the plan sponsor must suspend your loan payments due on outstanding loans that are in good order for up to 12 months. And that relief expires on December 31st, 2020. And the suspension period is added to the original loan term when the repayments, including accrued interest, resume regardless of the loan term. So you can suspend your loan, but your interest is still going to accrue. The nice thing about this is that as a typical retirement plan loan, it's 5 years. You cannot go past that 5 years. With this COVID relief, you are able to surpass that 5 years with this. So if you have a 5-year loan, you suspend it for a year, you're going to be able to keep that for that 6 years because you did suspend it due to COVID. Next slide, please. So the plan restrictions on the maximum number of loans still apply. So if your plan provided that you could only have 1 loan, participants could repay the existing loan and take a new one. You could refinance the existing loan if your plan permits. It is something written into the plan, so you would have to check with your plan sponsor. But you'd be able to refinance that loan, or the plan sponsor amends to allow more than 1 loan. And the 12-month look-back period still exists. So what that means is there's a guideline that says we look at the outstanding loan balance in the preceding 12 months when calculating the amount available. So let's say you want to take a $50,000 loan, but you've had a loan in the past 12 months. They're going to look at that highest balance, and they're going to say, well, you had a loan and your balance in the past 12 months, the highest balance was $5,000. You're only eligible then to take 45. So the 12-month look-back period still does exist. So, if you're thinking, I'm going to take a new $100,000 loan, but you've had one in the past, you're not going to be able to get that full $100,000. That's just a DOL regulation. All right, next slide. Okay, so you want to do these provisions. How do you amend your plan to do these? So the CARES Act has created a remedial amendment period, and you have to retroactively amend your plan no later than the last day of the first plan year starting January 1st, 2020. So if your plan year ends 12/31, you have until December 31st 2022 to amend your plan for these COVID provisions. So there's a lot of time that you can still make these decisions and that you can amend the plan. Now let's say that you want to allow loans for COVID, but your plan has never permitted loans in the past. So you would have to do a discretionary amendment to allow loans for this COVID. So it would have to be adopted, this discretionary amendment to allow loans, it would have to be adopted by the last day of the plan year. So to add the loans for COVID, you're going to have to amend your plan by 12/31/2020. So if you do want to do that, just make sure that you have that amendment signed by the end of this year. Now, the IRS is expected to issue guidance about the CARES Act and the document language. So if you've been wondering why your document provider, which could be your record keeper or your TPA, has not contacted you yet about this remedial, this amendment, it's because we're still waiting on the IRS regulations. We're looking for the document language. And since we don't have to have these amended until December 31st, 2022, it's just best practice to wait before issuing these amendments. So your TPA or your record keeper is going to make sure that guidance has been issued, that they have the correct document language before issuing any plan amendments. On a note, the IRS has also extended the last day of the initial remedial amendment period for 403B plans from March 31st to June 30th. And what that means is, if you're a 403B plan, you should have had your updated 403B document signed and completed by March 31st. If for some reason you did not have that restated document completed, you do have until June 30th this year to do that. So please make sure that you have your 403B plans signed and dated, completed by June 30th, 2020. Because if you don't, then you're going to have to go through one of the IRS's correction programs, and it can be pretty costly. So just make sure you get that signed. Next slide, please. All right, so we just talked about the defined contribution plans and how it affected you. And I would say the majority of people in a retirement plan are in a defined contribution plan. But what if your company offers a defined benefit plan? It's basically like a pension plan. So there is some relief on that. So single employer funding obligations during 2020 are not required to be made until January 1, 2021. And you have to include interest for the late payments. Now, what that means is if your defined benefit plan has mandated payments, let's say they have to make quarterly payments, they are able to withhold those payments until January 1st, 2021, but they do have to pay interest. And the interest is actually stated in your plan document. So, a lot of cash balance plans have a stated interest rate of 4%. Your employer would have to withhold, if they withheld those payments, they would have to make the late payment with a 4% interest. So a plan sponsor may also elect the plan's funded status for the 2019 plan year and determining the application on benefit restrictions for the plan years, including calendar year 2020. And so basically what that means is you can work with your actuary and you're able to look at your 2019 AFTAB to help with 2020. And that is definitely something your actuary will look at and work with you on and make sure that you're getting the best benefit restrictions you can. So CRDs are only available to participants ages 59.5 or older. And so like we just talked about with the defined contribution plans, that any eligible participant, which was someone who has COVID, somebody, they're dependent or a spouse has had COVID, or you've been adversely affected, like I said, layoffs, furloughs, business closure, childcare, we're able to take this provision if the plan sponsor elected. Well, in defined benefit plans, you can only be a participant who is affected and take it if you're age 59.5 or older. So that would be the major difference between defined contribution plans and defined benefit plans with the COVID distributions. Now, we just talked about how the IRS extended the 403B deadlines. Well, they've also done this for defined benefit plans. They are also in a restatement period, and your defined benefit plan should have been signed April 30th. If for some reason you did not get that signed by April 30th, you do have the ability to sign that plan by July 31st. So please make sure that you do have your plan signed by July 31st, because you do not want to go through one of those programs that, one of the protection programs. Next slide, please. Okay, so what's your responsibility as a plan sponsor? So the CARES Act are optional. You are not required to adopt the increased loan limits, the loan extensions, or the CRDs. It is your decision on which provisions to offer. And I kind of look at this at like a smorgasbord, like you're at a buffet. You can kind of pick and choose what you want to do. You could do none of them. You could just do the CRDs. You could do just the loans, or you could do all of them. So it is completely up to you what you want to do with your 401k plan or your defined benefit plan. So Doug had talked about document. Same thing here. You've got to keep good records. It's essential that you're working hand in hand with your record keeper and your TPA so this amendment is prepared correctly. So let's say the record keeper needs to know what provisions you've selected, if any, because if they have participants calling and saying, hey, I want to take one of those CRDs, they need to make sure that it's allowed in your plan. Or if they have participants calling and saying, hey, I want to take one of those enhanced loans, they need to make sure that that is going to be allowed in your plan. And the same with your TPA. If your TPA is doing your plan document, they need to know what provisions you're choosing. So when that document language is finally issued, we're going to be able to give you the right amendment. It's going to say that you elected this, this, and that, or it's going to say you only elected this. Or we're not going to do an amendment at all, because you did not choose anything. So just make sure that you are working hand in hand with your record keeper and your TPA, that we do get that amendment prepared correctly for you. Next slide. All right, so as a plan sponsor, why? Why would I offer this to my participants? So your company's been adversely affected by COVID. Your employees are furloughed or laid off. They've had a reduction in hours. Maybe your company was shut down, and we've seen it. I've talked to clients that own restaurants, dental practices. They were in retail. They've elected to offer some of these provisions for their employees because they were affected. Maybe they've been laid off. Maybe they're only working part-time now. Maybe the company was completely shut down, and they want to be able to help their participants make it through this time. So why not? Why would you not offer these provisions to your staff? Well, maybe your business was essential. Maybe it was minimally affected, or you actually prospered in COVID. I have talked to a couple different companies, fitness equipment, delivery services, landscaping companies that have actually done very well, or they've actually prospered. Fitness equipment, I've talked to a couple different fitness equipment clients, and they've done fantastic because people were ordering fitness equipment at home. There were no gyms. So, a lot of these companies don't have their staff that's affected. So they have not offered these provisions. And so Doug is going to speak next on financial planning, and he's also going to delve a little more into how offering these or not offering these will affect your participants. Doug?
Great. Can everybody hear me? Well, thank you, Bridget. Thank you, Doug. Until now, we've been discussing the impact of the CARES Act on companies, but I'm going to transition now to some thoughts on personal finance as it relates to the CARES Act, and even mention the Secure Act that was passed in December of 2019. Remember, the CARES Act was a massive relief package. To date, the U.S. has spent about $2.5 trillion on this problem. That compares to about 850 billion or so in the Eurozone, 600 billion in China. So the response of the United States has been something like 3 to 4 times what we're seeing around the world. But the emphasis here is on relief. As you well know from your businesses, our economic activity is comprised of 70% consumer spending. And never before in our history did we tell the consumer to stay at home. The impact on personal income was immense. The impact on your business as a result of the stay-at-home orders was immense. And we do hope for a quick recovery. Economists are predicting all kinds of things. I'm sure you've seen V-shaped and U-shaped and W-shaped and all these kinds of recoveries. And, but the aid was needed. It was needed quickly. So that's why we saw everything from the recovery rebates to compensation changes to some of these small business benefits Doug has talked about, but it also has some personal finance implications. And so this isn't intended to be comprehensive. We do only have so much time. So I'm going to try to highlight some of the provisions, what they say, and then try to summarize some of the applications. We do encourage you, if you have further questions, we'll attempt to answer them in a short Q&A that follows. But otherwise, we'd love to have you reach out for a more in-depth discussion. Let me circle back to Bridget's last point. Everything we've been talking about has been discussing relief for individuals and businesses. It was designed to provide quick access to cash and liquidity in a time of stress. And, as a financial planner, it is my sincere hope that clients were prepared for this. But that's not the reality. That's why we saw the $1,200 and $2,400 stimulus checks go out. So while these provisions provide relief, if you or your employees are in a position not to need the liquidity that Bridget was mentioning through the CRD and some of these loans, from a personal finance perspective, we would discourage accessing these. It's great that we have them. If we need them, we can get to those if you have the option available. But there's a big difference between whether or not you can and whether or not you should. And I'll mention Chris Rock's old line. You can drive a car with your feet if you want to, but that doesn't make it a good idea. If you're accessing these funds, it means you're converting assets likely invested in capital assets, which had declined substantially. We've seen a nice recovery, but it's possible we're converting these loans and these COVID-19 distributions to cash just to access these funds. And so it means we could be selling low. And frankly, it's this retirement savings leakage that makes it significantly harder for participants to reach their goals. And I would go as far as to suggest it can do irreparable damage to your retirement picture. We execute scenario-based retirement planning where we're trying to assign a probability of successfully retiring for clients. And these probabilities go down even substantially by accessing these. So I only say it was intended to be relief, but avoid it if you can. And just to underscore that point with an example, Bridget was talking about the expanded loan provisions. If you take a significant loan, even up to the max of say something like $100,000, remember that has to be paid back over the 6-year period that she mentioned. So you're looking at $15,000 to $20,000 of principal payments plus interest, and that can put a strain on disposable income going forward. So although you have access, it was intended to be a short-term Band-Aid, and we just say simply use caution. So as we look at the next slide, what are some of I'll call them constructive, but maybe opportunities and things we should be looking at in regards to the CARES Act? What should we be thinking about? This is administrative. It's pretty simple. I didn't put it in there. Just be aware the deadlines were extended to July 15th. For contributions to IRAs and SEPs and so forth. So we have a little more time, just be aware of that. But notably, as part of the CARES Act, required minimum distributions have been waived for 2020. If you're not familiar with that, a required distribution is required to be taken from your retirement account so the IRS can tax it once you reach your 70s. And so while that may or may not apply to some of you on this call, It may apply to your employees, your family members, so we want you to be aware of it. I do want to backtrack for just a minute. I mentioned the Secure Act. The Secure Act was another piece of legislation, perhaps the most significant piece of retirement plan legislation since 2006. And so these kind of laws are few and far between. But it did change a number of things, and significantly, it altered the age at which these required minimum distributions are set to begin. Prior to the Secure Act, it was 70 and a half years old. Now it is 72. So we had Secure passed in December, and then we had CARES Act passed in March. Bridget, did you have something to say?
Oh, can you hear me?
Yeah.
Okay, so the RMDs have been waived for retirement plans except the defined benefit plans. And they don't know if that was an error or if that was intentional. So more guidance may be provided on that. But as of right now, if you have a defined benefit plan, you will have to take your RMD unless additional guidance is published.
Yep, great. Thank you for that clarification.
Yeah, yeah.
I'm not going to spend a lot of time on it. You see the bullet point there, but we are running short on time. I did want to mention that the Secure Act eliminated the stretch provision for IRAs. So if you inherited an IRA prior to the Secure Act in December, you could stretch that out over your lifetime. That has been changed. You now need to distribute an inherited IRA over 10 years. There's a lot of moving parts to this, but I did want to mention on this call, it does have an impact on how assets are transitioned to the next generation. And I'm not going to get into the finer details, but I did want to say this can impact some trusts as beneficiaries of your retirement plan. I'm not going to go into it here. Maybe we can answer it on the Q&A. But if you've named your trust as the beneficiary of a retirement plan, depending on the structure of that trust, it can have an adverse tax impact down the road. So I just want to encourage you, review your beneficiary designations, and I would encourage a call to your attorney just to see if naming your trust as the beneficiary could have an impact on how the assets are transferred. I didn't mention this in the slide. It came to mind after I submitted them, but as we're talking about the COVID-19 distributions, you know, as we think about personal finance and some of, if you want to call them opportunities, one of the things that is we're seeing some inquiry about is we have a 2-household income. We don't necessarily need the income, but we are impacted by COVID-19. We have enough income to get through the year, but the future is uncertain. Retirement plans, as Bridget knows, put an awful lot of restrictions on just being able to get the money out. And so these CRD, these COVID-19 distributions only are effective for the calendar year 2020. And so we're seeing some questions about, well, what happens if this lingers into 2021? What if I need access then? And in 2021, I may not be able to use the CRD provision. As Bridget mentioned, if you have access, you can take those funds out of your retirement plan in cash. But we are seeing inquiries about taking that money and putting it into an IRA. And so by doing that, IRAs have a lot fewer retirement plan restrictions on how to get the access if you would need access to cash in the future. So we are seeing some inquiries about using the COVID-19 distribution, putting it in the IRA, and just leaving it there in case they would need to access it in the future. So it's something that is being considered. I did want to mention charitable giving for just a second, especially in regards to the minimum distribution. The CARES Act did not impact your ability to give charitably from your IRA after age 70 and a half, and that age still applies. This is what is known as the qualified charitable distribution. We had a lot of clients using that, and the question came up, well, if the RMDs are in fact waived for 2020, can I still make a charitable distribution from my IRA? And the answer to that is yes. So if this is you, please continue to support the local agencies in our community, the arts, the houses of worship, especially this year as they're going through some challenges. And if you have questions, of course, we're happy to answer those. But of course, we have a terrific Licking County Foundation in our community, and I'm sure if you give Dean or Connie a call, they'd be happy to guide you through the steps. We're at 10 minutes, so I'm just going to skip ahead. I did want to mention, although the CARES Act did not put this provision in place, as it regards to personal finance, there are some of you who may in fact be covered by a health savings account. And the question has come up, am I able to fund that? What if I can't fund that this year? And so there's a little known provision that allows you to convert once in your lifetime part of your IRA and roll that into a health savings account. Health savings accounts effectively behave a lot like IRAs once you reach age 65. So we still consider them a retirement asset, but you have the ability to convert part of your IRA. That number for the HSA this year is $7,100 if you're under age 55, and then there's some catch-ups. But you can convert up to the HSA contribution limit and roll part of your IRA into your HSA. So you can't put cash in on top of that, but just be aware, while it's not part of the CARES Act, that is a way to get some dollars into a health savings account. And then finally, as we move to the next slide, I put questionable planning opportunities here with a question mark. We're seeing some creative ideas and some things that we've heard, and two that I want to mention to you. One is, what about Roth conversions? We would say that Roth conversions in a time of market volatility like we've seen can make a lot of sense if you're just doing a traditional conversion. As we saw assets decline in March, what happens if we just do the conversion, pay the tax today, and try to put the growth into a Roth going forward? I think that that's worthy of consideration, especially if we see more volatility this year. But we have seen this idea about what happens if we use the COVID-19 distribution to pull out the $100,000 and roll it back into a Roth IRA. The advantage being that we could spread out the taxation of that Roth conversion over a 3-year period instead of one, recognizing that all in 2020. Any guidance we've seen, and that will be the point, the IRS, the CARES Act seems to provide very loose language that I would call a loophole. But I would tell you, I think it significantly violates the spirit of the CARES Act. And it's one that the IRS has some precedent in going back and after the fact, reversing this or clarifying. And I would tell you that if this is a consideration for you, I would assume that just wait, be patient. If the IRS gives some guidance, fantastic. But otherwise, I think you might find that you end up with a Roth conversion entirely taxable in the calendar year 2020. I'm going to skip over my last point here as we're coming up on the close of the hour with about 5 minutes to go, and just open it up for any questions for the three of us. So thank you very much for your attention today.
Thanks, Doug. If you guys, like Doug said, if you guys have any questions, make sure you submit those in now. We do have a few PPP questions that popped up. So Doug Houser, I'm going to go ahead and start on these. Has it been clarified if someone is paid over the 100K that the $15,385 will be forgiven and the rest would not count towards the loan used?
So again, they haven't clarified for the extension to 24 weeks for the covered period. The assumption is, and I'd say this is 99% certain, that will be pro rata over that period. So take that 100,000 pro rata either over 8 weeks, which is 15,385, or the 24 weeks, which is I believe 46,000 and some change. You are certainly welcome to pay somebody more than that during that period. It's just that that is the maximum that will be eligible for forgiveness. So you can compensate folks, again, more than that amount. It's just that that will be the maximum eligible for one individual towards that forgiven loan amount. So hopefully that clarifies it. Certainly, if not, reach out to me directly. We can get into specific facts and circumstances for anybody.
Great. We got 2 more here. So can the PPP loan funds still only be used to cover 8 weeks of payroll, and the 8 weeks can now occur anywhere inside of the 24 weeks? Or can the funds now be used to cover up to 24 weeks of payroll?
They can be used to cover up to 24 weeks. The idea was that for some businesses that were really severely impacted, that the 8 weeks wouldn't allow them to chew up all of those PPP funds. So you now have 24 weeks to use those funds as it relates to the PPP. What you can use them for did not change. Again, it's payroll cost as defined, rent, utilities, and mortgage interest as defined. The rent, we get this a lot too. Can it be related party rent? The answer is yes, as long as you have a lease in place and you haven't altered that lease in any material sense. So again, facts and circumstances are always different, but yeah, you have the full 24 weeks to chew through all those costs and apply for forgiveness.
Great. And we are reaching our last question here for you, Doug. And if you guys have any questions, feel free to submit them now. And if not, you're always welcome to reach out to any of the speakers. So the last question we have here is, we had a 2-week payroll that was earned prior to receipt of our PPP funds, but actually paid 2 days after the loan proceeds were received. Are we correct in using the PPP funds for this specific payroll?
Yes, that's an anomaly. And again, they allowed a lot of flexibility in that. So even though all that pay, or most of it, according to the facts and circumstances there, was earned prior to receipt of the PPP loan, as long as it was paid during the covered measurement period, you can include all of that in your forgiveness application. So again, there really is the ability to try to stretch this as much as you can. So that was a nice allowance that they made for it. So the answer is yes, that can be included.
Great. I'll give you guys a chance to give some concluding thoughts, and then we'll wrap up today's presentation.
Thanks, Imani, and thanks to all those in the audience, and thank you as well to the Licking County Foundation for its support as well. And we're happy to help those in the community here. Feel free to stop by our Newark office, which is in the Newark space on the square, or give any of us a call. We're all Licking County residents and care deeply about what's going on. So Brigette, Doug, I'm sure you've got maybe some final thoughts too.
Yeah, so I just want to tell everybody, that we're here as a resource. If you have any questions on your retirement plans, please feel free to reach out. Like Doug said, we're here in Licking County. We have a spot here at the Newark Center. I'm more than happy to help anyone that has questions with their retirement needs.
Great. And I'll just echo Brigette and Doug's comments. We enjoy being part of the community. And if you have any questions, let us know.
Awesome. Thanks, guys. And thank you for joining us for today's webinar on PPP Forgiveness, Guidance, and CARES Act Impact on Financial Planning and Retirement Plans. We hope that the team was able to provide you with some valuable insight today. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Doug Houser, Brigette, and Doug Feller directly. You can also contact any of our RAE team members by clicking on the People section of the firm's website at www.reacpa.com. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webinar, and more. Thank you again, and we hope you guys have a great day.
Thanks.
Thank you.
Thank you.